Welcome to Prompt Your Life. I'm Christoph Theodor. And today we are breaking down the critical intelligence and high stakes moves shaping this landscape.
If you've been looking for ways to generate income from your portfolio lately, you've probably seen the ads. In a world where standard savings accounts and normal stock dividends offer modest returns, a specific type of fund is marketing distribution yields of 10, 11, or 12% a year. Those double-digit numbers immediately force a question. Are these funds actually generating that much sustainable cash, or is there a structural catch that eventually eats away at your original investment? To answer that, we have to look at the mechanics of covered call ETFs. The strategy starts conventionally enough. The ETF buys and holds a basket of standard stocks, like the Nasdaq 100 or the S&P 500, to serve as the foundation of the fund. But the massive yields on top of those stocks don't come from corporate dividends. In finance, you don't get double-digit payouts for free. Those high distributions represent a strict trade-off, where you are exchanging your future growth potential for cash today. Here is how that trade-off works. The ETF acts as what options traders call a writer. Every month, the fund sells a contract, a call option, to someone else. This contract gives the buyer the right to purchase the ETF's shares at a predetermined price, known as the strike price. For selling this right, the ETF immediately collects a cash fee from the buyer. This fee is called the premium, and it is the exact money that gets passed down to you as those monthly distributions. This chart shows exactly what you are giving up to get that cash. Look at a single stock scenario, like Microsoft. The blue line is holding the stock normally. Your potential profit grows as the stock goes up. But the red line tracks the covered call strategy. It completely levels off at a specific price point. If Microsoft has a blowout quarter and its stock doubles in value, you do not get to participate in that rally. You are contractually obligated to sell those shares at the agreed-upon strike price. Your maximum profit is strictly capped at that strike price, plus the cash premium you collected up front. A covered call ETF takes this exact mathematical ceiling and applies it to an entire index of hundreds of stocks, repeating the process month after month. You are essentially selling away your right to ever hit a home run in the stock market. In exchange, you get a highly predictable, steady stream of singles paid out in cash. Because of that strict mathematical cap, the success of a covered call ETF depends entirely on what the broader economy is doing. The absolute best environment for this strategy is a sideways market. This is a period where stocks bounce up and down slightly but make zero real progress over months or even years. This graphic shows the 4 scenarios. Look at the sideways market and modest uptrend panels. Here, a traditional index fund delivers little return, but the covered call ETF consistently outperforms, collecting monthly premiums while stocks stay below the strike price. But look at the strong uptrend panel. When the market goes on a massive run, the standard index leaves the covered call strategy in the dust. The ETF hits its cap early and misses the rest of the rally entirely. This chart shows the VIX index, which measures market volatility and fear. Since 2020, you can see the average volatility level jumped from around 15 up to over 21. When volatility is high, option buyers are willing to pay much more for those contracts. That means higher VIX levels result in higher monthly distributions for the ETF investor. But it also means the market expects turbulence, and the underlying stocks in your ETF are likely experiencing heavy stress. These funds are highly efficient at taking market noise and turning it into cash flow. But they achieve that by systematically sacrificing the compound growth that normally builds wealth during bull markets. There is a persistent idea that those high premiums act as a safety net if the market crashes. Mathematically, the premium does soften the blow slightly, but it is only a fractional cushion. It does not stop a major loss. We saw this play out recently. In April 2025, sudden tariff announcements triggered a rapid stock market sell-off. During that plunge, covered call ETFs dropped almost exactly as hard and as fast as standard unprotected index funds. The real damage happens right after the crash. When the market bounces back in a sharp V-shaped recovery, the standard index rides that wave all the way back to the top. The covered call ETF hits its option strike price almost immediately and gets locked out of the recovery. This creates a highly unfavorable setup. You take the full brunt of the elevator ride down during a crash, but you have to take the stairs back up. If you do decide to enter this space, you have to choose how the options are managed. Passive funds follow a rigid, mechanical set of rules every month, regardless of market conditions. Active funds allow managers to adjust the strike prices based on their immediate market outlook. Usually, active management comes with high fees, but in the covered call ETF space, the costs are surprisingly competitive. You can find actively managed option strategies with total expense ratios as low as 0.35%. This list shows the reality for European investors. There are currently very few high-volume UCITFs-compliant covered call ETFs available, mostly concentrated on US tech or large-cap indexes. Your selection comes down to whether you trust an automated formula to write your options, or whether you want a human manager attempting to navigate around the strategy's inherent flaws. To see the long-term impact of trading growth for income, we have to look at the historical data. This table compares a Nasdaq 100 covered call ETF to a standard Nasdaq 100 ETF over a decade. The standard index beat the covered call strategy every single year, except for the heavy bear market of 2022. This data shows risk metrics. The covered call strategy had lower volatility, with a maximum drawdown of -17% versus the standard ETF's -28%. But the standard ETF delivered a risk-reward ratio of 1.12, while the covered call only managed 0.78. For every unit of risk you took on, the standard index simply paid you more. This highlights the risk of substance loss. If a fund pays out massive 12% distributions while the underlying assets are dropping in value, it is often just returning your own original capital back to you, disguised as income. From a strict mathematical standpoint, if your goal is to compound your money and build long-term wealth, this strategy is highly inefficient. For young investors with decades ahead of them, these funds are a mathematical trap. The opportunity cost of missing major bull market runs will cost you far more over 30 years than whatever cash premiums you collect today. There is really only one logical user for a covered call ETF, the strict income seeker. If you are already retired and your absolute top priority is generating current, monthly cash flow to pay your bills, this strategy delivers exactly that. However, if your goal is simply to reduce the overall risk in your portfolio, there are far more efficient ways to do it. You are generally better off keeping your stocks in standard index funds to capture the full upside and moving a larger percentage of your money into bonds, fixed-term deposits, or money market funds for safety. You have to accept that the principal value of a covered call ETF is unlikely to grow significantly over time, and it remains fully exposed to sudden market shocks. Covered call ETFs are not a superior way to invest in the stock market. They are a specific transaction where you trade your future growth potential for a paycheck right now. You should only buy them if you truly need that paycheck more than the growth.
Disclaimer: the content on this channel is for informational and entertainment purposes only. I am presenting my personal investments and strategies here as part of Prompt Your Life. This does not constitute investment advice, a recommendation to buy, or financial analysis. Investments in the capital market are associated with risks. Always act at your own risk and responsibility.